In this video, we're going to work through an example of deferred revenue in accounting. Hey there, welcome back to Accounting Stuff. I'm James, and in a moment's time, I'm going to take you through all of the adjusting entries for a deferred revenue example. 2 examples. And just as a heads up, this video is part of a mini series that I've created covering adjusting entries in accounting, which you can find linked up here and down below in the description. Last week we did prepaid expenses, and very soon I'll be making more videos covering accrued expenses and accrued revenue. So hit the subscribe button and click on the bell so you don't miss out on any of those. But today we're going to focus on deferred revenue. Let's get started. As usual, I'd like to kick things off with a definition. Deferred revenue is what we call the payments that a business receives in advance for goods or services that haven't yet been delivered or provided. You might have heard of prepaid revenue or even unearned revenue. Well, all of these are actually the same thing. They're just different ways of saying deferred revenue. Okay, that's a bit odd. 3 different terms that all mean the same thing. Let's try clear things up with a couple of examples. In this first one, I want you to imagine that you're the owner of a seaplane. Random, I know, but bear with me. I live in Vancouver, and for a while now, I've been wanting to visit Vancouver Island. If I were to take the ferry out there, this whole trip would take me 3 to 4 hours. But lucky for me, you own a seaplane. So I head downtown to the seaplane terminal and boom, there's a spot on your seaplane and it's leaving in 20 minutes. The ticket cost me $200, so I pay you the money and half an hour later, we're checking out the beautiful gardens on the island. In this transaction, you're the seller and I'm the buyer. You provided me with a service by flying me out from Vancouver all the way over to the island. The question is, how should you account for this transaction? Well, as the owner of the seaplane, you've received $200 in cash. Cash is a type of asset, the A in dealer, so debits increase it and credits decrease it. Your cash balance has gone up, so you need to debit your cash account by $200 to increase your cash. The other side of this transaction is going to affect revenue in your income statement. Revenue is the R in dealer, a normal credit account, so credits increase it and debits decrease it. Your revenue has gone up, so you credit your revenue account by $200 to increase your income. This is what your journal entry looks like. And we can see how this journal entry affects your general ledger using T accounts. Sorry, I've got a sore throat today. This journal entry affects 2 accounts, cash and revenue. Remember, when using T accounts, debits always go on the left and credits always go on the right. So we debit your cash T account by $200 to increase cash in your balance sheet, and we credit the revenue T account by $200 to increase revenue in your income statement. Nice one. That's the first example finished. It wasn't so bad, was it? You're probably thinking, well, yes, because there weren't any adjusting entries in this one. You are spot on. This transaction didn't include any deferred revenue or adjusting entries of any kind because both the payment and services happened on the same day in the same accounting period. For deferred revenue to get involved in all of this, we would need a special set of circumstances. I would need to have paid you in advance in a past accounting period, and you would need to be providing me with the service in the future accounting period. I'll show you how this works in this second example. This time, no more seaplanes. I want you to picture yourself as a commercial pilot on a passenger jet. It's June and I'm getting homesick. I want to buy a return flight from Vancouver to the UK to see all of my friends and family. It's been ages since my last visit, so this time I decide to go there for a whole month. I buy a return flight for $800 in June on your airline. My outbound flight is going to be the next month in July, and the return leg is going to happen the following month in August. This is our timeline. We have 3 accounting periods, June, July, and August. To account for this transaction, you're going to need to post 3 adjusting entries, 1 in each month. So let's do the first one. In June, I paid for my tickets, but from your point of view at the airline, you received $800 in cash. You need to post a journal to debit your cash account by $800 to increase your cash. Right, up to this point, this journal is looking very familiar. It's basically the same as the one from the first example. You just need to post another $800 credit to revenue and we're This is embarrassing, let me think. You're a commercial pilot of an international airline. Large businesses like that use the accrual basis of accounting. But if we were to recognize this income right now, then we would be cash accounting, because in cash accounting, you record revenue as you receive the cash. Whoops, so I wasn't meant to credit revenue this time round because we are accrual accounting. Okay, I think I've got this now. This time, we don't credit revenue in the income statement because we are accrual accounting. In accrual accounting, revenue is recognized as it's earned, not when cash changes hands. You haven't provided me with a service yet, so you can't recognize any of this revenue. So this entry can't go anywhere that affects the income statement. So that leaves us with one option, the balance sheet. But is deferred revenue an asset or a liability? Let's work it out. Assets bring us future economic benefit, whereas liabilities involve a future economic sacrifice. In this situation, I've already paid for a plane ticket, so now it's down to you to fly me out to the UK and back. You've got work to do, so you are going to make a future economic sacrifice. So you need to recognize this deferred revenue as a liability in the balance sheet. In fact, deferred revenue is always recognized as a liability in the balance sheet. So the other side of this journal entry is going to need to increase our deferred revenue in the balance sheet. Deferred revenue is a liability, the L in dealer, so it's a normal credit account. Credits increase it and debits decrease it. So you need to credit your deferred revenue in the balance sheet to increase it by $800. Let's see how this journal affects your general ledger. Now you've got three tier accounts, cash and deferred revenue in the balance sheet, and revenue, normal revenue, in the income statement. Your cash account has a debit balance of $800 from my initial payment, and your unearned or prepaid revenue account holds a liability of $800. The normal revenue account is empty because we can't recognize any revenue at this point. Let's fast forward to the end of July. You've flown me out to London, so half of my return trip is complete. If revenue is recorded as it's earned, then you've earned half of your income. The problem is, as things currently stand, you're holding $800 as a liability in the balance sheet. This deferred revenue is not the same thing as normal revenue that flows through your income statement. You're going to need to post an adjusting entry to fix this situation. Let's do it. We'll start off by debiting deferred revenue by $400 because we want to reduce this liability in the balance sheet and release half of it to the income statement. But where does the other side of this adjusting journal entry go? We need to credit the revenue account by $400 to increase our revenue in the income statement. Let's jot down how this adjusting entry is going to affect your T accounts. We need to debit the left-hand side of the deferred revenue T account by $400 and credit the right-hand side of the revenue T account by $400. So as things currently stand, you have cash of $800 from that initial payment and you are holding deferred revenue of $400 as a liability in your balance sheet. We've released the other $400, which we now recognize as revenue in the income statement. In August, you fly me back to Vancouver, so the second leg of our round trip is complete. You have one more adjusting entry to post. This adjusting entry is going to be exactly the same as the one that we posted previously. We need to debit deferred revenue by $400 to decrease it in the balance sheet and credit the normal revenue account by $400 to increase that in the income statement. You post this adjusting journal entry and it hits your general ledger. So in your August balance sheet, you are still carrying that $800 of cash from the initial transaction, but you no longer have any deferred revenue. Why? Because it has all been released to the income statement. $400 in July when you performed half of the services, and the other $400 in August where you completed the round trip. You have successfully recorded your revenues as they were earned, so your books are in line with the accrual basis of accounting. Nice one. This was part 3 in the Adjusting Entries mini-series. I'm going to be releasing more videos covering accrued expenses and accrued revenue very soon. So click on this circle to subscribe so you don't miss out on any of those. I've already made videos covering the big picture of adjusting entries and prepaid expenses, which you can find in the playlist over here. As always, if you've got any questions, let me know down below in the comments or message me directly on Instagram @accountingstuff.